Hi, I'm Mark Jarvis, and today we'll be looking at the corporate presentation for Giga Metals. We recently completed a preliminary economic assessment that modeled a production capacity of 37,000 tons per year of nickel for a 37-year mine life. The project is built in stages. The first half size runs for 5 years in our model, and then it beefs up. So we ended up averaging 33,000 tons per year of nickel over a 37-year mine life. And we're at the point that we're looking for strategic partners to invest at the project level to advance the project. British Columbia is an excellent mining jurisdiction, as is Canada. There are significant challenges with getting an environmental assessment approved. However, it is done. We think this project, just because of the way it's situated and the terrain that it's in, will be not easy, never easy in Canada, but we can certainly get through an environmental assessment on this project. And the thing about having a robust environmental regime is that as a buyer of the products, in this case, nickel and cobalt, you can be satisfied that your materials have been ethically sourced. So it's a very large resource. We make a high-grade concentrate. One of the strengths of the project is the simplicity of the flow sheet. You blast and dig the rock out, crush it, grind it, put it through a froth flotation circuit. And this is all old tech. It's reliable, and it's simple, compared to HPAL, which is incredibly complex, and even compared to other large low-grade sulfide nickel deposits of a similar scale. Our flow sheet is simpler. We don't require desliming circuits, for example, and we don't require magnetic separation circuits. Another strength of our project is that this will be a low-carbon nickel mine. And in fact, we've got empirical data to back our belief that we could get to carbon neutral in terms of producing concentrate at the mine gate. It's a very nice product. This is concentrate that's very suitable. In fact, it would be a premium product for a smelter to buy, which is what we modeled in our PEA. But there's also flexibility with concentrate of this grade and this clean concentrate that you could put in a pressure oxidation circuit and produce other intermediate products, such as, for example, mixed hydroxide precipitate. Historically, we've done 17 different tests on Turnagain concentrate. And in fact, they were lower grade Turnagain concentrates than we can produce now. And we've proven the amenability of our concentrate to a pressure oxidation circuit and ultimately the production of mixed hydroxide precipitate, MHP. And we make a particularly high quality MHP out of our product, the excellent grades of nickel and cobalt, very low manganese. Manganese is a deleterious element in MHP. So in fact, we're studying whether to include that circuit at the tail end of our concentrator for our next round of engineering studies. And so far, things are looking quite positive for that. Our tailings, as we've designed them, are built, world-class tailings management facility. And the site is right. I mean, it's relatively low precipitation. We've got low seismic risk. And the CO2 sequestration that we're modeling in our tailings, which is something I'll talk about more shortly, the silicate sands, the fines that we would spread out as part of our tailings, as they sequester CO2, they go through a process of cementation. So an already safely constructed tailings management facility becomes even safer. We've analyzed nickel prices over the last 40 years, inflated to $2020. It's quite interesting when you look at it. I was surprised to see that the average price of nickel over the last 40 years is $11 a pound. And we have been trading for a number of years now, since 2011, at below the average price. And we are currently trading at below the average price. What's changed? Well, the rise of electric vehicles has changed. And some of the market studies that we've looked at estimate that nickel, which is currently about 2.5 million tons per year total market, only half of the production is suitable for batteries. Well, there's estimates that if the electric vehicle revolution continues to take off, that will require an additional 1.5 to 2.5 million tons per year for batteries alone of nickel. This is the equivalent of 40 to 70 new large mines coming on stream by 2040. And when I say large, of a scale, similar to Turnagain, 35,000 tons a year of nickel or so. This is actually the whole reason I got involved with this project at first. I like large deposits that have marginal economics at the low point of the commodity cycle. So when you run our PEA at $7.50 a pound, we've got a depreciated net present value after tax, depreciated net present value at an 8% discount rate of negative $443 million. We're sitting with a market capitalization of about 30 million Canadian. But as you start moving the price up, the balloon effect on the depreciated net present value is quite astonishing with a deposit this large. If you assume, $10 a pound nickel, which is still below the average price, our depreciated net present value is almost $500 million US. And if it moves to $12, slightly over the long-term average price, our after-tax depreciated net present value is over $1 billion US. So this is leverage. So our economics, as discussed, are marginal at current nickel prices. However, they're superior to high-pressure, high-temperature acid leach project. We've compared our model to 4 different greenfields HPAL projects. And so for one thing, to get to a similar scale, because our project is suitable for development in stages, we never have as much money at risk. So this shows the cumulative cash flow. As you're building the mine, your cash flow goes below zero because you're running negative cash flow. And then as you start producing, your cash flow starts to rise. As you can see, for 20 years at least, we are well ahead of HPAL projects. And yet, HPAL projects are getting built. It's interesting to wonder why when the economics are like this. And I believe it's because if your cost of capital is very low and you're thinking strategically as the Chinese are, then you simply bite the capital costs and you have established for yourself a long-term supply of nickel at what amounts to a fixed price contract, that fixed price being your cost of production. So the Chinese are doing this. This is the case of, state-run capitalism beats the regular kind of capitalism. Further comparison with laterite deposits, we're a hard rock open pit deposit. And so it's going to be a great big hole in the ground. However, the amount of material that you move, relative to your footprint is small compared to laterite projects. And laterite projects are basically strip mines as compared to open pit mines. They're relatively thin and they go on and on for kilometer after kilometer. In the tropics, at least, what you're doing is you're tearing down tropical rainforests to get at the dirt underneath, the nickel-rich dirt. So there's a lot of erosion potential, a lot of river contamination, ocean contamination, a lot of biodiversity impact. And also a lot of the projects, simply dump their tailings into the ocean. So in terms of environmental impact, a project like ours is much more friendly than these laterite deposits. And in terms of carbon intensity, sulfide deposits are just inherently less carbon intensive than laterite deposits, either by HPAL. And if you start looking at taking nickel pig iron, converting it to matte, then going to precursor materials that route, the carbon intensity is off the scale. So again, if you're looking for ethically sourced materials for your batteries, for your electric vehicles, you prefer a sulfide deposit. In our case, we modeled our carbon intensity in our latest engineering study. That carbon intensity is 2.24 tons of CO2 equivalent per ton of nickel produced at the mine gate. That was using a diesel fleet. The reason we modeled it that way is that that's the equipment that's available. We think the market is evolving and that in the near future, we could have access to an electrified fleet instead of a diesel fleet. If that's true, that would take our carbon emissions down to 0.69 tons of CO2 per ton of nickel produced. And then we've got some test work that quantifies the CO2 sequestration of our tailings. And if you take that into account, That will get us down to a carbon neutral mine to produce concentrate at the mine gate, which puts us at the very low end of the range. Even before the CO2 sequestration, that puts us at the very bottom end of the range in terms of competing projects, in terms of CO2 intensity. We're going up to camp this year. We've got a bunch of drilling to do. A lot of it is resource drilling that will convert any inferred resources we've got in the current mine plan to indicated so that we can advance the engineering to the pre-feasibility level. We've also got considerable geotechnical drilling to do, both in the area of the pit and in the tailings impoundment facility. So why invest in Giga? Well, if you believe that nickel has to go higher in order to stimulate the supply needed for lithium-ion batteries for the electric vehicle business and for power storage, then Giga is an extremely leveraged way to play that belief, because our depreciated net present value, as shown earlier, will expand so rapidly as the nickel price goes higher. Again, there's a lot of new projects needed to come on stream. Those will have to be incentivized by higher nickel prices. We've got a product with ultimate flexibility in downstream processing. We can sell directly to a smelter. In fact, it's a premium product for smelters, but we can also look at creating mixed hydroxide precipitate, which is emerging as the new standard intermediate material for battery makers. We've got a strong board with good connections with capital markets. And two people in particular I'd like to point out: Martin Vidra, who is a director and our president, and Bob Morris, who is a director of the company. Martin had a 31-year career at Sherritt, where he sold nickel and cobalt to end users. So all of the end users, all of the strategics know Martin very well, and he knows them. Bob Morris had a similar position at Vale, the big iron ore producer, but it's also one of the largest mining companies in the world. He was in charge of worldwide sales for base metals. It was a portfolio that, depending on commodities prices, ranged between $5 and $8 billion a year in value. Bob is also known to all of the end users and the strategics. So we've got sort of a head start, if you will, in talking to the strategic. Here's a look at our capital structure. And again, our market capitalization, Canadian $33 million, with a large project, very leveraged to the price of nickel. Thank you very much for listening.